Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here, Curtis Scouten. Jumping into the charts on this October 28th, closing yet another week positive in the overall stock market. And today's rip-roaring rally was a mega surge, being the fact that this daily chart doesn't even show that we were actually down in the overnights, and you pretty much rallied from this 374 area all the way up to this 389, 390 area. A massive rally for the overall S&P 500. This rally was primarily led on the back of Apple. If we take a look at Apple stock, it's not very often that you see Apple basically moving up 7.56%. And if we actually flip to the intraday chart on Apple, Apple had a mega reversal. Basically, it traded all the way down to 136 yesterday on earnings, and it pretty much gapped and made a massive run. So if you factor in that type of move, Apple has had from yesterday's low to today's high a 15% swing on a multi-trillion-dollar company. That is an exceptional move, might I add. Now, the interesting thing about Apple, and people are so optimistic and bullish all of a sudden based off of this price action, but if we simply look at Apple's price action, Apple now hit the 200 daily moving average, and it also retraced back to this important trend line that we broke. This is major resistance on Apple. The fact that you've hit it in one fell straight swoop, one shot, definitely dictates that you need at the minimum consolidation to go higher, but I think we're going to get a minimum pullback back to this 152 area. Now, there is important technical daily gaps on Apple that need to be filled still, but nonetheless, I think Apple's hitting major resistance, and I do think we're going to see some consolidation. There is the potential that you could float all the way back up to this channel. I think the markets are kind of a little bit relieved with the fact that earnings are now done and that they're also potentially pricing in a Federal Reserve pause or pivot. Now, if the Federal Reserve doesn't pause and pivot, or they come out with a 75 basis point hike and a more hawkish tone, these markets could start seeing some significant downside very quickly. Even if the Fed pivots, I think the market has anticipated the Fed pivoting. That's why we're seeing this sharp, exorbitant rally. Even if we take a look at the S&P 500, let's not forget that Microsoft, Google, Amazon, Meta, they were all pretty crappy earnings. And with those multi-trillion and hundreds of billion-dollar market caps, those certainly should weigh on the indices. But we've kind of seen the S&P and the NASDAQ be a little bit more resilient than most people have anticipated on the back of those earnings. But let's not forget that this is still a bear market in my opinion. Even with the Fed pause or pivot, yes, we're seeing a rally which could take us a little bit higher than most people expect, but we have clear resistance points to accumulate short positions on the markets. The interest rates that have made a massive rate of change have not even hit the real economy yet. So these companies are still going to feel the interest rate hikes moving forward. It's not a matter of that these interest rates are only going to stay elevated for basically, a 1 year period, or not even, they haven't even been elevated for a 1 year period. But if we simply look at the basically the rate of change movement, yes, interest rates could fall down, but even if we're trading at between 3 and 4%, that is still astronomically higher in comparison to where the markets were trading, which gave them those lofty valuations. So I still think that we're going to see more downside in interest rates. You can clearly see that interest rates have retraced back to this initial bear flag pattern. The bullish factor about the US 2-year yield, and it was really interesting to see that yields were up substantially on the day today. The US 2-year was up 3.36%. The US dollar was also up on the day. If we flip to that chart, you can see it had a positive day, retracing back to that 50-day moving average, bouncing off and closing just slightly positive on the day. But when you have yields positive and the stock market positive, that's kind of a negative divergence for the bond market. Here today, with such a powerful rip-roaring rally in yields, the bond market was decimated yet again on today's market session. And whenever you see the bond market getting decimated but the stock market moving substantially higher and pretty much negating the move in the bond market, that is a red flag in my opinion. Now, with that understanding in mind, I do think yields will head lower over time, but the rate of change movement, in the sense that how low we go and how fast we go, is really going to dictate whether or not we're slipping into a deep global recession, and whether or not this market can and will have a sustained rally. So I still think that the markets will see more downside in the medium to long term. Short term, they could see more upside, but we have our clear resistance levels. For the US 2-year yield to rally up, over 3% in one day, and the markets just shrug that off like it's nothing, that is pretty incredible to see. But again, I do not like that negative divergence that happens between the bond market and the stock market. The bond market is the bigger market, it's the smarter market, so when you have yields surging, and which means bonds are getting decimated, and yet stocks are surging higher, generally what we've seen over the divergence periods between stocks and bonds is stocks always play catch up to the downside. Now, we have to keep in mind there's still a topping formation in play on the S&P 500. We have two retrace levels which we're watching very, very closely. The first one is this COVID trend line, which will be our first major level. That's the big question on yields. Are we going to be able to, or on the stock market, are we going to be able to get through this level and close above it? If we get through that level, then you have the original neckline of the head and shoulders topping formation. If you retrace back to that level, it will probably coincide with the downsloping 200 daily moving average, which will be an epic level to short and accumulate for at least a minimum conservative pullback. But I think we bounce basically back off that level and keep trending lower. There's probably going to be something in the economy that signals more downside for this market. If we take a look at the IWM was strong today as well. It's basically approaching also its head and shoulders neckline. You can see it's very close. This was a fake print that one of my other traders got, which we're approaching very closely as well. Take a look at the QQQ. Basically, the QQQ is at short-term resistance. Obviously, it's lagging with the likes of Amazon down, Meta down, but nonetheless, the 50-day moving average is barreling down on the NASDAQ, along with this down-sloping trend line. You still have a topping formation in play on the NASDAQ, which you have not fulfilled the downside yet. So let's just keep in mind that this over-exuberance with people piling into the stock market as if the economy is going to be booming again, even though GDP came in strong, this and unemployment obviously still at historical lows. We have to keep in mind that inflation still remains. Inflation can come back with a vengeance. If you look at the price of oil right now, yes, it's trading substantially lower in comparison to where it was, but needless to say, oil is starting to put in a little bit of minor consolidation, which could take this higher. Now, I'm still kind of bearish on oil just due to midterms. If you throw on this trend line, you have this double resistance, this down-sloping trend line, as well as this pivot high parallel channel, which if you get through this red trend line, then you have another secondary resistance point here. If you get through that, then you have another third resistance. So there's a lot of resistance points in close proximity, which are kind of keeping the oil price at bay at this point in time. Natural gas. Natural gas is interesting because you are still technically consolidating inside of this wide range green bar. As long as you hold your daily closes inside of that bar, this is still technically bullish consolidation in the minor pattern. Now the major and the intermediate pattern is down, so you could always see this level break to the downside, but nonetheless the minor pattern is still bullishly consolidating. I would naturally anticipate that we're going to see a break in natural gas, either break up or break down basically next week. You're approaching this apex of the triangle here in this wedge pattern, and it's going to make a move either up or down. And the big question is, in the short term, you still are technically holding bullish consolidation for a move up, probably to this gap fill around 667, which was your multi-day consolidation before breaking lower. Let's take a look at the gold chart, shall we? Gold was under significant pressure, and this is kind of why I'm suspect of this rally. You saw gold react to the negative, you saw gold react to yields, you also saw gold react to the positive dollar. So the only thing that was really defying the yield and the dollar market today was stocks. And when you factor in that gold did not rally with the stock market, that is kind of a bearish divergence again. Same thing with silver. Silver was under immense pressure today. Let me just pull up the silver chart. Silver, there's nothing really to report on silver. You're just kind of trading in this wedge formation. Basically, silver is still looking to make a move in which direction. The short-term positive is that you are bullishly consolidating on the minor time frame pattern, which means that we should see a move one way or another to the most likely to the upside, at least to this test this resistance channel or these pivot tops up here around the 2075 mark. So again, silver's closing above its key short-term moving averages, so that does imply that there's still some bullish buying and accumulation occurring. I just want to touch base on a couple sectors and why I still think we're going to head lower. We were looking at the correlation of lumber to the S&P 500, and when we had this amazing rally in the lumber market, we were saying, okay, generally when lumber rallies, the stock market is very close to following it behind. And that's what we saw was lumber rallied first, the stock market was getting punished, and then the stock market played catch up. Now lumber is falling sharply, and which means that generally if it follows the same correlation that it has this year, the stock market should also see some downside. Lumber is very important to the housing market. It does require 16,000 square foot of board lumber to build the average home, so it is a massive part in the overall economic demand and output. Another one I want to touch base on is copper. The price action is copper should be alarming. With a massive rally in the stock market, copper was down 2.57%. So the commodities have really been responding negatively. And when you look at copper and identify copper as the most important or one of the most important and most used industrial metal, it's the largest base metal that we have in our economy. Copper is a great indication to the overall economy and where we should expect stocks to go. Typically when you see copper putting in bearish formation, that is not a strong signal for the overall economy. And here we have a beautiful bear flag forming. You can see that it's stuck in this beautiful upsloping parallel channel, and it's teetering on the brink of losing this weekly 200 moving average. So that is certainly not a good sign. This weekly bear flag does dictate a sharp move down in copper, which would signify that the economy is in a lot of trouble. So again, copper is the most used base metal in the world, which is why it's such an important metric for our overall economy. Looking at energy sector has been the leading sector, but it's also showing signs of distribution at these all-time highs. You have a beautiful double top in a beautiful extended move, but now you are hitting massive resistance in the energy sector. You can see you have a trend line here going back to the mid-February of the beginning of the year, and this was your breakdown point in oil. And the fact that you've still been technically bearishly consolidating inside of this wide range reversal candles for the last 2 weeks here shows that the likelihood of this price action rolling over to the downside is more likely than not. And I think the price action is very reminiscent of the oil price like we've touched on. But again, when you have the energy sector making an extended move like this, it should see some downside. Obviously, we are shorting plays like Exxon. Exxon has been an incredible runner here. You can see that Exxon reported earnings, had strong earnings, but a move like this is just exponentially overbought in the short and medium term. Yes, there's the potential that you can float up to the top end of this channel around 114, 115, but you're at mega time resistance right now, and you should see a sharp pullback in Exxon. I am extremely bearish on the energy trade at this point in time because everybody is on this trade. The sentiment around the energy industry is basically bar none. I mean, everyone is bullish on energy, and when everyone is bullish, I can't be bullish on that sector knowing that we are heading into a global recession. Even if the Fed pivots, we're going to have a global recession that should decimate these energy stocks as well as the commodities. And when you see the likes of copper and lumber starting to underperform, that is a massive signal, in my opinion, that we're going to see some near-term downside after this bear market rally is basically had an exuberant move taken out and withdrawn. I just want to take a look at the utilities sector. So utilities are important because as utilities rally, that's generally with the stock market, that's kind of a bearish divergence as well. Typically, utilities are the defensive stocks, so when utilities are rallying with the stock market, that's never a good thing. But basically, utilities have broken and confirmed below a key trend line. This COVID trend line, which we're identifying, you potentially have a little bit more upside in utilities, but there's going to be a massive, massive level of resistance recapturing this this resistance point over here, sitting at around 68, 68.50. There is a technical gap over here at 68 and 68.90-ish, which you could see a pierce of that level and then a pullback. But the big question is, do we confirm above this key trend line? I just want to take a look at the broker dealers as well. So broker dealers have had a sharp move into resistance. Now most people would deem this a pretty much a bull flag that is forming, which it could be, but you have not broken out of this bull flag. And considering that you're at resistance and you failed at resistance here, the likelihood of you failing at resistance again is higher, just because you've had a 1, 2, 3, 4, 5 days of straight upside right into a resistance level, a major resistance level. This should see some near-term downside, which also generally means the stock market is, and the S&P is heavily correlated and tied to this broker-dealer sector. When the broker-dealers rally, the stock market rallies. When the broker-dealers tops, the stock market also tops. Taking a look at the home builders, again, are closing in on a key resistance. You can see this downsloping trend line here, as well as this important COVID trend line connecting a major pivot low to a major pivot low in July, and you're almost approaching that exact level as well. Now, the interesting thing about the price action in the SPY, let's just go back to that, is you're starting to trigger on a technical basis algorithms to start buying the S&P 500 here, since you got a positive daily close above the 50-day moving average. So what we could see on Monday is continued upside into these key resistance and then some consolidation. But the more we rally into the Fed meeting, the more I become basically, the more confident I am that they're going to draw bonus back down. And I still think that there's a major technical gap to the downside on the S&P around 357. Again, this was not filled with this tail here. This was your fake daily print. I still think we have to fill this downside target of 357 before making any meaningful challenge for this major pivot at 430. So again, we're close to major resistance. These two trend lines are the trend lines to beat, but everything technically inside of this head and shoulders topping formation is still inside bar bearish consolidation. If we take a look at the weekly chart, you are hitting your first short-term weekly moving average as resistance, which is your 25-day moving average. So again, there's resistance here. Nonetheless, resistance has been hit. Let me just see if I can touch base on anything else. Bitcoin is basically consolidating right now, trying to attempt at a potential bull flag here. It is still extremely premature to know if Bitcoin is going to continue this upside. Obviously, with a positive market close today, Bitcoin is potentially looking to consolidate and move higher. But again, on the 4-hour chart, the measured move for this pattern takes you to about 21.6, so there's not too much more upside in comparison to where we sold at this wick high. And just remember, we are still inside this wide range red daily candle here, which means that if we for some reason have a big sharp move all the way up to here, there's going to be a ton of sellers lurking right from this candle, also inside of this bar. If you actually just look at the price action, you have a wide range bar here, wide range red bar here, wide range red bar here, wide range red bar here. They're pretty much all within a range of each other. So there's sellers on a multiple weekly basis just sitting at these key levels here, waiting to offload and dump Bitcoin. So with that understanding in mind, heading into next week, obviously next week, Tuesday, Fed meeting starts. Then Wednesday, we have the big press conference from Jay Powell and the interest rate hike. The markets have slightly changed the probabilities that they're expecting a 0.5% hike. But the majority, the lines are showing and the odds are showing that we're most likely going to experience a 0.75% hike. I think it's still an overwhelmingly higher probability that we see the larger interest rate hike. But again, it's really going to hinge and dictate on what the Fed says and whether or not they're slowing down or pausing or tapering and reevaluating. If they pause and they say the P word, then we will probably see a massive surge in this market. But I think if this market does surge into the right levels, it's going to be a great level to continue to fade this market and short it on the way up. I don't think we're going to hit new all-time highs anytime soon. Even if the Fed does pause, we have to keep in mind that interest rates are still going to be historically elevated in comparison to where they were trading that sent these stocks on their rip-roaring rally. So let's just keep that in mind, that interest rates are still abnormally high. Even if they fall down to 3.5%, it's still an insane amount of extra basically interest in the overall debt system that companies are going to have to fulfill. And the longer interest rates stay elevated, the more pain that we will see. And let's not forget that we still have a yield curve that is severely inverted, being that the 2-year yield is paying a higher yield than the 10-year yield. So again, when the yield curve is inverted, there's pretty much almost a 100% success at calling a recession down the road. It's hard to pick the timing, but it does have a 100% success rate. And then we also got some interesting data that the personal savings rate is declining very, very sharply, and it's hitting basically lows that we have not seen in a long, long time. But the US 10-year yield has lost a key trend line. This is the level that it lost. You can see we had to retrace back to that level, trading in a little bit of a range here. And the big question is, when do we confirm below this low over here? Will it be potentially on Monday? What I'm seeing for yields is probably just a slight grind higher along this trend line to the upside until the Fed makes their decision. If the Fed is hawkish, yields will likely continue going up. But if the Fed is dovish, then yields are likely going to fall much, much lower, probably to this 3.6 to 3.48 level. That's probably going to be the next big level that yields fall to. It'll probably be a hit or a pierce of this 50-day daily moving average. So that's pretty much it for today's video. Obviously, we have to still be mindful that this is a bear market, but nonetheless, we'll respect the upside. And if the Fed if I see price action that leads me to think that we're going to push to at least test this 430 level in the S&P 500, I'll probably look to cover some of our shorts at a loss, just so that we can reaccumulate those short positions at better averages. With that being said, I hope everybody has a fantastic weekend, and we'll see you